Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee free transactions. Whether it's gaming, AI, or next gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Meet Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the powerful tools you and your organization need to trade and manage crypto at scale. Reliable, easy to integrate with white glove service and 24/7 support. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payword Interactive Inc. View legal disclosures at kraken.com/legal/disclosures. Welcome back to another Roundup edition of Forward Guidance. And I'm really excited to say that we have a special guest joining us today. Mr. Capital Flows, Global Flows, Capital Flows Research. Big fan. Had you on the show a few months ago, and we just had to get you on the Roundup and get you to chop it up with the fellas. So welcome.
Hey, thanks for having me. I'm a big fan of the show, and you guys bounce some thoughts back and forth. So I'm happy to be here.
We got Pepe himself,
Mr. Pepe himself.
Gotta rock the Pepe, man.
How's your guys' Thanksgiving? We didn't chat last week, but what's new with you guys?
Chilling. Got some time away from the screens. Refreshed, rejuvenated.
You guys won't recognize what this is like, but I had family in town and 3 kids, and then their kids, and it was just mayhem. I look like so haggard. Like you go from high volatility trading to 4 kids running around like maniacs. Good Lord, I had to drink.
Doesn't it get worse for Christmas though? Because you got to set up all these toys for Santa. And do they believe in Santa?
Yeah, that's fun. They still believe in Santa. I got 6, 4, and 2. So
hopefully they don't listen to this pod.
It's magical. It's not. Yeah, they don't. They hate this pod.
It's the hour where they can't talk to their dad every day.
Yeah. So.
Capital, how was your Thanksgiving?
It was good. Just spent some time with just family and good friends, and just had a good time. Just markets were closed for a day, so it's nice to just go and just basically did a hike, hung out with some friends and family and things like that. So all good.
Where are you located? San Francisco?
No way. I would never live there. No, I just don't want to live there. No, I'm in Arizona.
Okay. I was thinking mountainous. There we go.
It's like it's desert mountains kind of thing, but beautiful sunrises. So I always up, and I'll do a sunrise hike. I'll be up and to the top of the mountain as the sun is rising. So I love doing that.
I love that. Okay, we're recording this Friday. We just had the non-farm payrolls print. Lots to get into. I'm going to go through a few slides here and just get us all up to speed, and then we can chat about our different reactions to it. But non-farm payrolls print came in at 227,000, slightly above the consensus, roughly of 200,000. But that consensus was quite interesting because the variance of expectations was the widest I've ever seen. It kind of seemed like nobody really had a clue. So much of that was because of just the noise that came from last month in terms of hurricane data and some of those more idiosyncratic flows into the non-farm payrolls print. But interestingly, we saw an uptick in the unemployment rate, up to 4.2 from 4.1 on the last month. I don't have the unrounded numbers offhand here, but I know that it was very, very close to being actually a 4.3% roundup as well. So we did see a marginal increase there. The rest of the prints there, nothing too notable in terms of hourly average hourly earnings, that was fairly consistent. Saw a big reversal in the manufacturing payrolls, which was interesting. So, past few months has been negative. To see that revert higher, probably a lot of that had to do with the Boeing strike reversing out of that. And so what was also interesting is that we saw some positive revisions for once. So, this is the doomer's favorite slide for the past, year or so, because pretty much every time that we've had these prints, we've seen some downside revisions come back. But what's interesting is that this month we actually saw upward revisions. So September went from 223,000 to 255. October was revised up from 12,000 to 36,000. So putting those two together, you actually got like a 56,000 revision upward, which is super interesting. And again, really, I think if you're in the slightly slowdown camp, what was most interesting to you is probably the unemployment rate, especially with respect to what that looks like in terms of the FOMC's last dot plot, or SEP. You can see that we rebounded upwards here, which is definitely interesting. But at the same time, we saw a pretty significant beat on the non-farm payrolls print. So you kind of have to juggle those two things. But for me, this is the most interesting chart of all. I really rely on Econ Burger on Twitter. He's an absolute must follow for labor market data. I just big fan of his charts. So this is really the most interesting thing to me if you're trying to like get to the signal. And that's especially looking at permanent layoffs. We're seeing this continue to tick up higher. So, we've seen different moments throughout the last year where if you look at, say, the blue line temporary layoffs, like we saw a big surge in the unemployment rate because of temporary layoffs, and that reverted pretty quickly. But here we're seeing it's permanent layoffs. So that's a lot more structural. And again, this is just a quick chart I saw from Anna Wong this morning as well, just looking at actually the median duration of unemployment. Even though the unemployment rate itself has somewhat, flattened out a bit, we're still seeing an increase in the median duration of unemployment. So lots to take out there. Why don't we pass it to our special guest here, Capital Flows? Would love to just get what was your initial take on all of that, and how are you thinking about it?
I think the overall environment I still view us in is one where growth is positive. It's going to be tough to get this really imminent contraction over the next 3 to 6 months, right? You have this kind of theoretical higher R star where the economy is clearly less sensitive to the higher rates, but it's just going to take longer for those rates to work their way through the system. So I just think about it as you have this higher level of growth kind of step up in basis a little bit, but we're likely moving down closer to just running real GDP around 2%, as opposed to kind of this higher level that we had in 2023. So I just think we're still kind of in that trend where growth is normalizing and just moving down to kind of this sustainable level where you can actually get inflation down a bit more. And I think just the fact that we've had this rally in rates over the past 3 months and we moved up to this higher end of the range, just in my mind further kind of solidifies the setup for just a little bit softer growth as we move into next year, maybe a little bit higher credit spreads. I think the NFP print today just showed that. I think the headline number of the actual NFP payrolls, that was basically in line with expectations in my view, not a huge change. Is the unemployment rate that caused that to accelerate a little bit. That caused a bid in bonds and things to shift around a little bit. But the fact that you continue to see on the print today, bonds bid, stocks bid, it just shows that the liquidity impulse from lower rates is still more of a driver in markets than some type of contraction or recession or something like that. So I'm expecting a positive stock bond relationship. Those both rally together marginally.
The David Zervos camp.
Is that his camp?
Blues and blues. Yeah, he's basically saying risk parity is a good trade here if you believe the Fed is in control.
Yeah, I would agree with that. I mean, I think you almost want to do that because you have equities being pretty rich unless you're running specific rotations or you're trying to run some type of factor play. If you're just doing the index, I think running that with bonds is a great plan because any kind of move up in credit spreads, just given how low we are, if you're holding some bond exposure, that's going to be really helpful. Just from a trading perspective.
Quinn, what's your high level take on things?
Yeah, I think it's this interesting world where I agree with Capital Flows. It's the economy's weakening and slowing for sure. We've seen this with the bounces from in December 23 when the Fed kind of early declared victory on inflation that, gave us a little relief bounce into the first half of 24. We just battled through a summer slowdown, and now they've come screaming in with 100 basis points of cuts. And I find it interesting that the unemployment rate is still below most cyclical low levels we've ever had. So it's this interesting situation, and I think they're right to, if their goal is to support the economy, I think they're right to cut here because I do think it's weakening, and we're seeing a lot of the job growth government, and that's what happens in fiscal dominance. I loved how Powell in his speech said we are nowhere close to fiscal dominance, and I think that might be, in hindsight, looked back as maybe a bottom in that view. So yeah, I think it's like this weird situation where if they're going to keep cutting the biggest thing that gets me is every metric in their September estimate, GDP blown out above forecast, unemployment rate below forecast.
Here's a chart of that just to show from our buddy Andy Constant.
From Andy. Yeah, and inflation above. Yeah, you just got to play the game that's being played. Like, you can sit here and scream at the air and punch air. That's like, oh my God, they're cutting into this stagflationary economy, and but they shouldn't cut.
It's not stagflationary. I think the economy is hot, and it is strong, quite strong.
It's two speed. I think it's two speed. I think
I agree.
I think that theme will continue to resonate, because what I want to get into with capital flows and everybody else here is I agree this long bond trade has been the move, but if they're going to cut into this, I'm not sure that's the trade I want to be in anymore, because I would expect it is enough to rejuvenate and stimulate. I mean, if they cut again, China can bring more stimulus, Japan can go slower, ECB and Bank of Canada can go more, and I think then maybe commodities get bolstered for a little bit, and bond yields probably rise.
Do you mean cut in just December, or what pace? Okay. You give me your thoughts on this, because I think you have a cut in December, seems like it's confirmed, but then you have pause price for January, no meeting in February. So you have two meetings there, not two meetings, but two kind of months there where you're going to have this kind of more setup for a pause, right? And you still have Fed funds pretty, reasonably above inflation, right? So I wouldn't really, say, maybe, 25 basis points here or there, or, 10, 15 basis points or something like that here or there. I don't think that's enough, especially with the transmission we're seeing. I don't think that's enough to really push, to cause this massive bin in like crude or copper or, stuff like that. I think you still have a reasonable degree of of restrictiveness in that. How do you think about that?
I wish I had the answer. I think that's a push-pull here, because I see it as being extremely reflexive in both directions, where if the Fed came out hawkish, right, I think global central banks then are kind of, unless they want to sacrifice their currencies, are going to have to maybe be a little more hawkish. And the vice versa. If the Fed is saying, look, PCE's way above target and unemployment's below target and GDP's coming in almost a point above and we're going to cut, then China doesn't have to worry about their currency as much. They stimulate, and I think you maybe bring forward that bottom in goods disinflation, which we know services and everything else is kind of bottoming. And I think you help, the small and medium-sized enterprise sector. And I think it's inflationary. And I think unless something very bad happens, I think there's kind of a floor in long bonds. So I don't know if I would, I guess I would say if they cut in December, I'm more neutral to short. I don't know if it'd be my big, I shorted bonds heavy when the Fed cut in September, but maybe I do recognize and acknowledge the forces you're talking about. So it's less of a high conviction yet. I want to see more economic data, but the things I believe in are, one, I posted a chart this week. There was a Duke Business School survey that 35% of corporate CFOs postponed, delayed, or indefinitely paused investment and hiring decisions because of election uncertainty. So I think you have this huge unwind of backlog of catch-up activity. Also in the housing sector, we're seeing like new purchase applications doing pretty well. And then I think you also have a pull forward because everyone's so giddy on Trump animal spirits pro-business administration, and potentially like that narrative around pulling forward imports ahead of tariffs. So I think you have this backlog catch-up phenomenon plus pull forward of where you could see, if there's ever a 2 to 3 month stretch to get a big bounce, I think that's going into the inauguration, and then maybe some disappointment on some of this stuff taking longer to pan out.
So if you kind of think, let's say you just have that on the Trump side, right? You have the push or the the waiting, the backlog, and then the pull forward. Let's say that overlaps with just January and February when we don't have any cuts. Do you think that just kind of sets the stage for slowness after that backlog and pull forward just moves into the end of 2025, or how do you think about that?
Yeah, I think I'm aligned with you that I think it still would be almost, call it a dead cat bounce, because I do think the economy, like, there's a lot of inertia here that needs to be overcome, that I don't think gets overcome by just this December hike in a sustainable fashion. But it pains me because I haven't traded as well as I should, knowing this view, but I've viewed this as literally the same as December 2023. And I think, we saw basically what you described was Q1 24, right? Where we got that bounce. And then once they had to be a little, push out cuts, I think that, in April, that's what started the growth scare. So I think it's basically that again.
Curious, like Tyler, you mentioned there about how you feel like the economy's booming, surging, running pretty hot, but we're also talking a bit about like a reversal of this growth rebound. If you just think about like the economic surprise index as an easy gauge, we've been surprising to the upside, and now we're starting to talk about potential for surprising to the downside. But at the same time, there's like, we got the Michigan consumer survey today, which was one of the highest prints, I think, since like April 2023 or something like that. So, there's a lot of business optimism. Tyler, do you want to talk a bit about what you're seeing in terms of like just that hot economy idea that you're saying?
First off, let's look at, to stay on the topic of the Fed, check out slide 31. The Fed cut in December is basically already priced in. We have an 87% chance of a cut. If you look at that, there's that third column where it says 87.3% chance of a cut. So, I mean, I think the Fed's going to cut in December. Does it matter either way? I don't really think so. The event risk is, you're going to see the VIX pop ahead a couple of days ahead of it. People are going to start doing downside protection. That's going to roll off after the event risk, and then you're in holiday season. So that's sort of my game plan around this. 25 bips doesn't really matter. In terms of the growth, I think, like Quinn said, it really is two speed. I'm watching parts of the market taking off here. If you look at the ARC names, and you go through some of these charts, but let's say,
I love how we talk about these like every week because they're just fucking insane.
Dude, it's crazy.
Yeah, but they're going like,
right,
we
I
talked about
know.
ARC before it ran, and now it's starting to break out. And I'm like, okay, now we're starting to get the animal spirits going.
Yeah. So like, I think the market is trying to tell us that this administrative bureaucratic red tape that's been in the ether for corporations for so long, if Trump does what he says he does and Doge does what they said they were going to do, this is so bullish for incumbents and frontiers. So let's look at slide 36. This is the Goldman Sachs short basket, rolling short basket. It's an inverse head and shoulders where it's breaking out to the upside. And we brought this up. This is just early bull market for a lot of the stuff that's been left for dead. They've probably delevered, but their balance sheets made their companies a little bit more streamlined. And then go to ARKK is the next slide. Looks exactly very similar. Broke out from the breakdown levels. This is a 3-year consolidation here. So I don't know what people are smoking something, but growth might be going down for large cap tech or something, but largely underneath the hood, there's a lot of sectors that are just on fire. Look at the space stocks I talk about every week. SpaceX, did their valuation at $350 billion. Lunar, went to the moon along with Rocket Labs. So there's like, and I don't own any of these, so like I can talk about them, but these sectors of the economy are just doing really, really well. To talk about like growth scare, and then think about this: if you have unemployment going up, how much of that is because productivity is booming? What if all these like AI agents, like look at Salesforce, don't own it, went up 10%. They're saying the AI agents are being massively productive. They have like 200 new contracts coming down the pipe. If that happens, maybe we're in this productivity boom right now. And that's what I'm seeing personally. And then go to slide 30.
We have an AI agent on. We're forward. Capital Flows is just an AI agent.
He's just an agent.
You really don't know if I'm not. Yeah, there's really no way to prove that I'm not.
He sounds like a freaking algo.
Super quick. I just want to get Capital. I want to get your take on how you're viewing like, these speculative degen stuff breaking out here. And especially with respect to like, is it a productivity thing, or like, how do you view these? I don't know if I've heard your take on this.
No, I mean, Tyler's right. Like, that's exactly what's happening. I mean, when you have that safety net underneath growth, where you have a period of low delinquencies, and then you have the entire kind of like setup for interest rates to move back down a bit. I mean, if you just think about all of these, there's the short interest factor, or just the low quality factor. That's primarily companies that have a lot of leverage and that are smaller cap, right, Tyler? So it's so much of it is this massive unwind, right, from the obviously the environment that we've been in. I mean, that's why REITs have rallied so much this year, because everyone was super bearish commercial real estate, and they said, oh, all of this debt's going to roll over and commercial real estate's going to collapse, right? That didn't happen, right? So you have that, and then you have it overlapping with this entire TINA effect. And when you have large caps, as rich as they are, you're going to have underlying rotation. And I think Tyler probably speak to this a little bit more than me, but like the underlying the underlying, I'm bullish, man. I like this. I mean, the underlying rotation in the Russell, right? Like the companies that are in the Russell now, it's like no one's heard of these names, right? Like they're all new, right?
Yeah.
So I think you're seeing this just shift from just new winners coming in that are taking these new places in these factor indices, and that's getting all this new capital as we move to these cuts.
And if they're low floats, it's capital structure arbitrage. Check out, this is slide 38. So, we talk about this a lot. This is a high yield CDS for all these clowns like Mike Guyed. I kind of like that guy. I kind of like his shtick. Not gonna lie. But I don't really call him clown, but he's calling for a credit crisis every time, but he's not gonna look at the credit markets. And this is I do like him. I'm jealous. But credit is so good. Spreads are in. You have inflation down, and then check out, this is oil. Go to slide 30. Sorry, I'm like a college professor here with the slides, but
I love it. I'm just here to please.
The oil market is in surplus. Incremental barrels outpace the projected global demand increase in the oil market. So you're seeing oil's at 67 a barrel. So everyone calling for that, like even if the Fed eases, that's not necessarily commodity bullish. And if you have Trump, who's like very pro energy, to like decentralize energy supplies, you have massive nuclear capacity that could keep inflation down, oil supply, natural gas. So like there's a lot of parts of commodities will just be commodities, and the companies might buy back their stock and do well, but overall it doesn't mean we're going to have like this super cycle of commodity shock. That's where I'm starting to think differently, is like the productivity advances in a lot of the commodity things that would cause credit crises have changed. And like our ability to produce these things is better than it's ever been before. So
I fully agree. I want to pause here quickly on the energy market thing, because I know Capital Flows has been shorting oil. I know Quinn has talked about being brave and trying to catch the knife. I want to hear how you guys are thinking about this, because for me, I look at oil at $67 and I'm like, I don't see how we could be in stagflation, and I don't also see how we can get a significant rebound in inflation if we're just chopping around at the lower range of this bound. So maybe Capital, you can start quickly with why you've been shorting oil if you're still short oil, and then Clint, I'd love to hear the other side of potentially being brave and cashing that knife or not.
If you go to slide 25, I think that kind of connects these two views that are kind of on like both sides here, right? You have credit spreads in blue, and then you just have inflation swaps in white. And the main kind of idea is that, let's say this growth that we have, that we all kind of acknowledge, begins to transmit into inflation, right? Like that's why that'll inform how long I'm going to hold my bond long that I currently have on right now, right? And that would inform if I would flip and short bonds and then maybe have a longer short view on equities, depending on where we're at with valuations and inflation. But the main idea is that if those inflation swaps roll over, right, like, and growth stays where it is, that's pure Goldilocks. That's going to cause everything on the farther end of the risk curve to melt up. If you have those credit spreads rise and those inflation swaps fall, that's when you might have equities consolidate a little bit as bonds bid, right? And that's where you get a little bit of that maybe more unwind in growth, right? So I think in these scenarios, right, where you're like, how much of this growth story is going to have an impact on the growth side and then also on bonds, I just think about it as the market was mispricing bonds, in my view, when the 2-year went all the way up almost to Fed funds, right? So that was like a clear, like, clear long in bonds when we were at that top end of the range, because we're not going to go to hikes right now. That's my view. So basically, if you're pricing an unrealistic extreme, even if you don't know when you're going to have the a marginal shift, you price an unrealistic extreme, just take the other side and put your stops above where we would get hikes, right? Because I don't think we're getting hikes. So I'm basically holding that. But then within that, that's kind of the whole question of I think on the crude side is, I think we are just overall seeing like a huge ton of supply come online, and then every single geopolitical risk premium that comes into the market every single time just gets sold so hard, right? Like we had that rally in crude where implied vol blew out to 2022 levels, and like you couldn't move above 77, right? Like that just tells me, like, on a longer term basis, that everyone is mispricing that geopolitical risk. Then you have Trump coming in, supply is still in a big surplus, and you have growth slowing from 2023 levels, right? Or just moderating. I don't think we're moving to 5% real, right? So, overall, I think crude's moving to 50, right? And that's going to be part of what you could have for this, Goldilocks scenario in 2025. So that's how I think about it.
I love that. Another way to think about it that's not so financy is cartels. Cartels are made, like, if you think about a mob, right? Mob gets together and they control the price of things. That's what OPEC is. And you have this other factor now where, okay, now Trump's going to come in, maybe pump a little more. So now they go from, the cartel wants to keep prices high. So already that oil is priced higher than it should be. And if that cartel is forced to say, react to this new supplier, what are they going to do? They might even, start pumping even more to get ahead of it. So that's sort of, I'm kind of in that camp where you see break evens kind of fall, and you might even get this Goldilocks, especially, you have productivity, you have potential inflation rolling over, and then a Fed that is looking at the break evens and saying, we'll get back to a normal level of Fed funds. Like, you could be in kind of a Goldilocks. And I think stocks are telling you that here. The only things to watch out for is like multifamily housing, is bad. There's some commercial real estate credit stuff, but like, look at the 30 years coming in now. So as long as we don't have any crazy geopolitical events, it's looking Goldilocks to me, at least through January, because you also have systematic flows. Year-end buybacks until the 20th. That's when the buybacks turn off. That's why vol is at 12. By the way, thank you for the VIX during the election. If you bought 2 month out VIX puts, you would have fucking crushed it. And now we're watching, like, if you're talking about Michael Howell framework, credit spreads almost all-time lows, the VIX all-time lows. Your risk parity funds have to lever back up as the VIX falls. This is like, this is really good. I mean, there's a time when you're going to want to be a little bit, heading into January, maybe a little bit more conservative, but global collateral is very high. And then you have this kicker of like, I think we're in a giant fiscal super cycle from the globe. Everyone is in secular stagnation. It needs a balance sheet recession in China and Europe. I don't know if you caught, China's coming up with another meeting here. They might do something. And Europe said, we're going to do a $500 billion defense fund because Trump's going to pull out of NATO. So money is going to be sloshing around the system here, I think, globally, as far as the eye can see. But, we'll change our tune when the credit and the stuff says differently. But right now, things look pretty damn good in the macro.
Scale is shaking up the blockchain game. With a gas-free and visible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Meet your secure, reliable institutional crypto partner, Kraken Institutional. Whether you're an asset allocator, a trading firm, or high net worth individual, Kraken Institutional unlocks the full suite of tools you and your organization need to trade and manage crypto at scale. But it's more than just powerful products. It's about enabling you to build and grow your crypto practice via deep liquidity, industry-leading security, and white glove service. Think 24/7 support from an award-winning account management team and expert guidance through your institutional crypto journey, from onboarding to product demos and more. Experience it for yourself. Visit kraken.com/institutions and get in touch today. This is not investment advice. Crypto trading involves risk of loss and is offered to U.S. customers through Payward Interactive Inc. View legal disclosures at kraken.com/legal/disclosures.
You mispronounced a few words, China.
China.
You look at the list of assets on the screen, and we're all kind of describing why stocks are at a 23x forward earnings, S&P all-time highs, and the junkiest of junk is ripping. I mean, we are in Goldilocks. Like so yeah, I mean, the macro in me, I'm early to everything. So just bottle up everything I say and action it in 2 months, and you'll probably make way more money than me. I believe with credit spreads where they're at, I don't think you're going to get a big oil flush, commodity growth scare flush like you would in the past. There's a base level of economic growth supported by fiscal spending. And I think we've seen this. Remember when we had the recession scare in May 2023 after the banking crisis, that it lingered from April to May. We had this in Q4 of last year. This is another great analog to last year where, oil looked like it's going to go to zero and all these things, but every central bank and fiscal partner comes to the rescue, and spending is where it's at, and real nominal GDP are where it's at. And so while I agree that the overall growth trend is on a big picture basis is lower, I think there's fits and starts, because I think that, to be clear, I think the words I used, Felix, was the best hedge, I think, for a long crypto risk asset portfolio is oil. And yeah, prices come down, but there's still a positive carry on futures. So like, rather than shorting, stabbing at shorting stocks, like I still actually believe that to be the case. Or, an equivalent kind of similar trade is shorting bonds. It's kind of the same thing as rising inflation. I think there's a lot of narrative behind Trump drill, baby drill, and all these things. But in a physical commodity market, they're you can look through earnings growth for a stock and price that in, but when I need to put the gas in my car, I need the physical. And so I just think that for the same reasons you're in this Goldilocks environment, credit spreads are super tight, fiscal and monetary are pumping with no end in sight. I, for that reason, also think that it kind of puts a floor on oil and commodities. And ultimately, I think this cycle ends with the risk asset cycle ends when the Fed can no longer, with a straight face, cut interest rates because of where inflation is. And I still firmly believe that, unless, maybe day one, Doge cuts $2 trillion in the government spending. Yeah, I'm going to change my tune. I mean, that's a different story. But under the current framework, none of the stuff that Trump wants to do is going to happen in the first 6 months. Let's be honest. And so I think there's just a little bit of a hangover effect. And again, I've been wrong, but let's also not look past like oil seasonality and bond seasonality. We're in the meat of it. So I'm just kind of looking the other direction in that aspect. And remember, there's usually a little bit of time where those things bottom, but risk assets are still moving before they actually become problematic. If you look at like Q1 of last year and these other episodes. So that's my view. It's not like be 100% outright net long oil and these things, because I agree that there's still pressure on growth. But it's like, if I'm looking to hedge a portfolio of risk, it's inflationary protection assets, which they haven't been in vogue. And so prices and everything else have gone up. And so like, that's the point of a hedge, I guess.
You know what though, in your defense, the actual stocks, like if you could look at like XLE, they're way better run. And I think a lot of them are doing buybacks instead. Like it used to be you'd pump oil and you'd immediately supply it to the market. And now I think they're doing a little financial engineering. So the stocks might perform way better than the commodity.
They have outperformed tremendously. Yeah. And so how do you structure that?
That's Tony Greer's type thing, right? Is that he's thinking like oil lower, but he's still bullish XLE because of like efficiencies from, margins increasing.
Yeah. And like Exxon's big announcement yesterday, they're decreasing their investment. So like multiple, it's always nuanced, right?
You know what's kind of crazy? This is just a thought experiment, but like we managed to economically put rockets into outer space, and the cost to do that is dropping astronomically. So like think about the productivity unlocks from just existentially of what that means. So just to pump oil should be relatively way easier. You know what I mean? Relative to put a satellite thing up in space. And you can when you have on your phone anywhere on the planet, like, come on, let's pumping oil. What?
Well, it's not about what we can do. It's about woke social justice warriors preventing it. But we won't go down that rabbit hole. We've been good with.
We've been keeping it chill, guys. Come on.
Okay,
leave it to Tyler and I to.
Let's change the subject to.
I'm actually curious. So for the inflation side, where do you think inflation needs to get? Like, let's for core headline to kind of create that situation that you're talking about. Like, do you think core like 3.5 or 4, or what do you think?
Well, I think it's a two-sided equation of where the Fed is and where inflation is. So if I think PCE is bottomed personally. So if that's at 3 in December and base effects don't really get easier, like, and then we're talking the Fed in December takes rates down to 425, 450. I mean, and GDP's printing 3 in real, 5, not 6 nominal. We'll have to, like, I only see like 2 or 3 more cuts. I see like 2 or 3 more cuts max in next year without a big growth issue. So like, it's kind of chicken and the egg, right? Like, as long as the economy stays where it's at, the Fed's going to have to stay restrictive. And it's just like, just stop-start environment is what I call it. So I guess to answer your question, 3.25, I think, because I guess if the Fed gets down to 400, 375, 400 in the first half of next year, and the economy's still cooking, then I think 325, they're still going to want some restriction probably. So it's, I guess, like, I don't think it's that much higher. Yeah.
Something we haven't talked about yet is on this upcoming December meeting is a Fed dot plot meeting. So not only are we going to get yes or no on the December cut, but we'll also get their upcoming forecast. Something that I've been digging into, just because I actually wrote like an article about this on the Blockworks website that came out yesterday, but I've been digging it a bit more onto R star because that seems to be what the FOMC is starting to discuss about a lot more recently. So just to get everybody quickly up to speed here on R star, there's some areas where we can dive in a lot deeper into this, but basically it's just that the estimation of where the neutral rate is in the economy. It cannot be directly observed, so fancy quant models are used to try to estimate it. And the two fancy quant models that are most popular are the Lubick model and the Williams model. So this chart is actually from a recent Richmond Fed piece where they started to dig in, to start to question these ideas of where we're at, because this is what's so key to getting to capital. I mentioned this at the start of the show, but knowing where we bottom out on the like where the terminal rate is on the rate cutting cycle is very closely anchored to basically which model you believe in here. And you can see this dispersion, right? So the Lubick model has us with a neutral rate that's way higher than what the Williams model is. The Williams model is what is most popular and most popularly used at the Fed. John Williams, who's the creator of it, is the New York Fed president, so has a lot of more esteem with it, associated with it. And if you use that model, this is why the Fed keeps saying we still think we're restrictive, because if you look at the Williams model here, we're on the floor here in terms of that. But if you use the Lubick model, which has, it's a more of a statistical based model, it reacts more dynamically to major shifts in the economy. We're almost already at neutral if you go for that argument. So
this Williams model is saying the R star is 0.8%.
Yeah, on a real basis.
Got it.
So then you add on the 2%.
It's real.
Yeah,
okay.
yeah.
I was like,
yeah.
Whoa. I was like, these guys must have the fattest crypto bags on the planet. It's like John Williams is gonna make his profile picture freaking Pudgy Penguin if he thinks the real interest rate should be 0.8%.
No. Yeah, this is real. So if you are on the Lubick side of things, that dot plot that they come in within the December meeting, depending on where they put that terminal rate on, you could already see them end up being an accommodative monetary policy. But if you're on the Williams camp, even if they cut a couple more times, they're still technically restrictive. So I feel like this is the big debate at hand. And this is why there's constant infighting, is it sort of depends which school of thought you're in. So I don't know. I mean, you brought this up originally, Capital. Go ahead, Tyler.
Is this what they teach you at CFA school?
Oh, no. Brutal.
Man, fuck.
The only that I don't have anything. The only thing that comes to mind on this is I would say this whole topic of discussion I put in a similar camp as the Fed balance sheet, where there's no bullish upside to this whole debate. And same with the Fed balance sheet. The things on the Fed balance sheet topic for discussion is reducing the size and moving to a bills only, which are both putting duration in the market on a net. And same for this. The discussion here is not should R star be lower? The question is, should R star be higher? So that's all I have to add is put that in the back of your mind for 2025 is I would say neither of these things to have the debate are positive for risk.
Yeah, I don't know. I mean, the way I think about this whole thing is I don't use any of. I think R star, the academic calculations of it, are pretty much useless. But I think I have a way of modeling that myself.
You can roast the CFA too. It's all good.
I think this. Oh man.
Dude,
yeah,
the ball's on this guy. He comes on the show second time. He's already roasted you, dude.
I'll be nice. No, I really don't put a lot of weight in a chart like this, just personally. But what I will say is I think you have this entire setup where you're basically trying to figure out how much of restrictiveness and transmission those rates are having into the line item for a company, right? So I think it all comes down to you have all these different agents in terms of corporations, consumers. The government matters a little bit less, but corporations, consumers, commercial banks, right? And then you have, if interest rates are moving up, how much is that increasing their debt service cost? and then you basically take that number and say, how much is that eating into their earnings growth or their top line revenue, or how much is it more creating like, credit risk? And like the way I think about it is like I basically model like where is all the debt for this in terms of like the weighted average maturity for like all of these different agents. Bring it together. I think we're seeing more and more short duration, right? Like, we're seeing companies and high yield and things like that have a lot shorter duration in their debt, right? And so I think overall, right, it has more to do with like when is where is that spectrum, and how is that eating into like earnings for specific companies, right? Because I think that's the biggest thing. We're seeing so much dispersion, right, across like all of these different names, which is why you have the trash stocks rallying and the low quality stocks rallying. So I think overall, if I were to like have a view of R star, I think overall, anytime you have nominal, GDP running above 5, right, you're going to have to, rates, remain at a higher level. And I think there's still that whole idea of like rates cause like things to be more restrictive is dependent on how much those debt service costs can transmit into those companies, which is a very dynamic thing in itself, right? So I think like I model that and I try to find like specific sectors that I know have their growth like below R star and stuff like that.
Can I transition this into something pretty tangible in the market?
Yeah, please do.
Because I love
Yeah, get us away from academia.
Okay.
I'm so sorry.
Well, like, let's translate this into market history. So like one of my favorite interviews I ever did, I interviewed this guy, Brian Reynolds, on Real Vision about the debt markets. He was this old school bond trader from like Boston. He's like, yeah, Tyler, he's got one of those voices. And, but he was like, back in the day, bonds were just a backwater. It used to be all AAA bonds. And AAA bonds, you've only bought AAA bonds. And then Mike Milliken came along and he created the junk bond market. And so this is, you could go to slide 33 to read this along with me. So Mike Milliken, this is kind of like a history of the junk bond market. So Drexel Burnham's first junk bond financing was in April of 1977. It was a $30 million bond for Texas International, a small oil exploration company. Milliken went on to finance Rupert Murdoch as he transformed News Corp into an international powerhouse, and Craig McCaw as he built a nationwide cellular communications company with 2 million subscribers before selling it to AT&T for $11.5 billion. Milliken helped billionaire entrepreneur John Malone grow his cable empire and helped Bill McGowan create MCI, which competed with AT&T. Milliken got billionaire Ron Perelman the money he needed to buy Revlon, the deal that put him on the map. So Milliken created the junk bond market, which allowed like the building out of these giant industries that formerly were excommunicated from the market. So you could actually be riskier. To your point about like raising on the short end, you had the junk bond market was on the short end, but you could raise money to build out these industries. To sort of pivot that into what's happening in crypto. One of our big themes of a big unlock for the value of an asset is use as collateral. So when you're able to borrow against an asset, it changes the entire dynamics of the equity. And, something I call it the Milliken moment for crypto is the issuance of convertible bonds have been an absolute game changer. So I think what's happening is like Milliken used junk debt to finance the building out of cable, news, all these industries that we know now. We're watching the use of high volatility convertible bonds for these crypto assets is the best way to finance the crypto industry. And so if you go to slide 32, this is just in the last month. This is from a BTIG note. Capital for high performance compute, mining growth in Bitcoin. Over the last 2 months, roughly $4 billion of capital have been raised as companies look to position themselves for the ongoing HPC data center opportunity, Bitcoin mining infrastructure growth, and a rig renewal cycle, and for BTC purchases. So the convert market, you're borrowing money from the TradFi market, from pensions, from insurance companies, from endowments, and that is going to build out the infrastructure for crypto companies and AI. And so we're watching the Milliken moment of crypto here before our very eyes. What happens when you issue a convertible bond? I feel like I'm Stephen A. Smith here, by the way. Stephen A. Smith of crypto just ranting. So me off. What I think we're witnessing here is it's an emergence of the entire world was short volatility for 40 years. Risk aversion. Now you're seeing people utilize the volatility in their stock to issue converts. So what are you doing when you issue a convert? Instead of doing an at the money equity issuance or secondary, you're not diluting your stock anymore. So we're seeing certain pockets of the market that formerly would dilute their stock for growth. They're using the fixed income markets, this convertible, to essentially, like, I can't mention names, but you're getting really advantageous rates. And if you don't want to dilute your stock, that means your earnings are better. You're selling your stock up 40, 50% in a convert, meaning like you sell a 0% bond and then the call option is struck 40, 50% higher. You're not necessarily diluting your stock. You will later, but it's not like an ATM where you're just increasing the supply of your float. So long story short is I really think that idea of when the liquidity spigots are open at R-star or whatever, things are at a really neutral rate, you have capital. We're watching financial arbitrage, capital structure arbitrage before our very eyes. And this is exactly what Milliken did for all these industries. It's happening in crypto, and Trump blew it open. In all these, all these pension funds, the amount of money that they're financing, you don't have to dilute your stock anymore. You can issue converts. So if you have high volatility in your stock, this is a total game changer, but no one's really paying attention to it. Did I speak enough?
I gotta just, because we can't let Tyler have all the roasts, and since he gives Felix some CFA crap. Yeah, we just got a good diversity because Felix, can lend on his CFA knowledge, and Tyler's just like the 6'6" jock of the group.
Hold on, Quinn's also done the CFA too, right?
Yeah, I quit after level 2. I passed both, and then I went to crypto, so I didn't need it. But Tyler's the look at ARC, Carvana, chart up.
Yeah, you go. Hey, there's some guys that can just play the game.
Yeah, there are.
You think Kobe Bryant? You think Kobe Bryant? This is a 40-foot jumper, and my arc needs to be 76%. He shot that bitch.
Okay. What's really the most interesting takeaway from that for me is, when you hear about the zero coupon bond issuance, people, okay, so how is Saylor and now these miners that are starting to do it, how are they getting free money? And the answer, and it's starting to make sense to me, is that they're selling volatility, right? So that's what the convertible are, guys. What they're getting is the yield on the volatility on a delta neutral basis. And the exchange for that is that they're not getting a coupon. Once I understood that, it started to make more sense.
And think about that. You don't have to pay money. And I'm not talking at specific stocks here. I'm talking the sector in general. It's wide open. It used to, these stocks are now, you can utilize your debt instead of your equity to finance. So like, think about that does to short interest. They're high short interest, right? People think that and so this is the exact thing that's going on. Why I show you the Goldman Sachs short basket is the same phenomenon. If you can issue higher up in the money, higher up in the capital structure, it causes short squeezes because it takes away the tail risk of bankruptcy. And so that's why the liquidity cycle is so powerful and why Paul's framework works.
Capital, I want to ask you about how you think about Bitcoin and crypto, because you had an interesting report this week where you're starting to dig into some of the option dynamics and just how like call skew in that starts to get reflected in Bitcoin. And I think that ties in a lot to what Tyler just mentioned in terms of like basically what we're seeing is like the securitization of Bitcoin, and that's having really interesting dynamics in the market. So how do you think about that?
Yeah, I mean, on the note of the converts, I think that plays into how you interpret Bitcoin now, because in my view, it's, converts right now are almost just kind of like another type of financial, not that they're necessarily new, but another type of financial mechanism, kind of like SPACs in like 2021, right? Where you're just having this new way for like capital to flow to be used for whatever people want, right? So it's just like another type of like liquidity valve. But in terms of like Saylor doing that, and obviously you have all these other companies that have, that are holding Bitcoin now or things like that, right? You haven't had a ton of options traded on, Bitcoin spot or on the ETF itself, right? So like the main metric for, if someone wants to, buy calls, they're not doing it on like the IBIT ETF or something like that, right? They're doing it on these stocks because there's just so much options traded on them, stuff like that. Which is why, I think in terms of the implied vol blowing out on like Coinbase, MicroStrategy, some of the miners like Riot or whatever else, like that's been setting short-term tops in Bitcoin and things like that. And then also kind of like, I think it's mapping the positioning and the premiums people are paying a lot more now.
I got a chart for that.
Oh, you got a chart? Dude,
Yeah,
what slide is that? What slide is that?
Slide 39. So we don't own this, but it's one of the ones I can show. This is slide 39. This is the brief history of IBIT. So I think this is to talk about what actually happened over the past week. I think you're nailing it, which is the IBIT options opened up, and the white line is the implied volatility, right? The historical vol is the orange line. So what happened was people raced. They're like, oh, the options market opened up on Bitcoin spot on IBIT. I'm going to go buy calls. So they jammed up the implied vol on spot, and we had that initial ramp. And then, because they probably bought the wrong timeline, like, first of all, never buy volatility in like the front month. It's so stupid unless it really presents itself. But so these retail traders ran to buy IBIT options, got absolutely smashed. Remember when we talked about, when people are buying insurance, you want to be selling it? This chart shows that the insurance premium spiked when the options market opened up. And now they got all slammed. And we saw that slam lower. We saw all the call option buyer in the entire sector. And this looks a lot similar to a lot of other parts of the market. So those call buyers got absolutely annihilated because everyone's degen. And now it's back to like, it's probably finding its level of implied to realized right now. That's a good spread. So the market's cleared. And then I would love for you guys to get into the funding markets after this, but capital flows, you take it away.
Well, I think that's just right. I don't think we have a chart of MicroStrategy, but you basically had MicroStrategy blow out to the upside.
I do have a chart of the implied vol surface here. That's sort of helpful just to see over the past month.
Yeah.
Go ahead.
You basically had call skew blow out for MicroStrategy to the upside. And that happened right before the IBIT options were released, right? So like all of us or like people were like trying to front run that because we know that like when you have, a new liquidity mechanism on a product released and you see a proxy for that has options on it, like blow out to the upside before that, you probably should take a gain, right? That's why MicroStrategy went down or has been lower and hasn't made an all-time high as Bitcoin hit 100K the other day, right? So like those positioning premiums in Bitcoin are now inherently connected to companies like MicroStrategy and then also like Coinbase and stuff like that. I mean, Coinbase, I think, is an interesting one because you've had it move in more of a durable way because I think everyone's trading the options as exposure on MicroStrategy more than Coinbase. I'd have to double check that on like the volume, but I'm pretty sure that's true. But I think the kind of setup that you have now is you're going to have all of these different types of people try to get exposure in some way, and to the conversation of convertibles. They might not be taking on a ton more credit risk or something like that, but that doesn't mean like a stock can't gap down 50% or you can't have this huge washout just as you reprice the premium that the stock is trading at. That's what people are like missing is they think, okay, because they might not be forced to sell Bitcoin or something like that, that means the stock can't go down, right? Or that means like we're good. But there's in my view, especially for MicroStrategy, there's going to be this moment where you're going to have this like massive washout because people are misunderstanding that like once you have some type of liquidity shock or even positioning unwind, given how many options are traded on MicroStrategy, like that thing could go down. That could gap down a crazy amount in a day. So I think there's actually in my view, not because I'm intrinsically bearish on MicroStrategy or Bitcoin, I think there's just going to be a point where, buying the left tail on MicroStrategy is going to be really interesting.
Yeah. I think another one too is just the levered ETFs on MicroStrategy. Like I've seen some interesting analysis about what that could do if we see like a certain, sigma move
you have
to the downside.
Like flows move into those new levered ETFs.
Go ahead.
Yeah, levered ETFs on MicroStrategy. Go ahead.
Just on your point, Capital. Yeah, it would. Next Friday is the, what a huge event that is usually never an event, which is the NASDAQ inclusion release for MicroStrategy, and there's a ton of speculation and that the buyers of that stock that it's going to get included in the NASDAQ, and all the passive flows and front running that brings, and potential kind of perpetual bid that allows them to buy Bitcoin in perpetuity. And your point around said potential unwind could be if there's a disappointment in that event. I don't love that it's weak going into that event, right? Normally you'd expect it to be a bit stronger. And I wish Tyler could talk about this, because he's probably like, hey, price good, you dumb. But I just want to go on the record, and I don't.
You make me sound like Gronkowski. Is that
no, dude. You have such good like intellectual takes. I love how you can play both sides. But I just
good.
But I just have to give you shit.
I love how he like speaks down to you on that. Like, oh, like us CFAs, like you guys that don't have them, just like such. Like, oh, you have an intellectual take sometime. It's just like, that wasn't a compliment, man.
No, but I think that personally, I don't think I think there's a very little chance it gets included in the NASDAQ. The S&P already left it out of the index. So there's no FOMO risk there, right? If the S&P included, it'd be like, and then, the NASDAQ included, earlier in the year, SMCI was kind of had some issues, maybe some egg on their face, and it's a committee decision, right? So there's like 30 or so stocks that are shortlisted based on market cap, and then the committee decides, do we want these in the NASDAQ? And I think there's so much, I really only see career risk if they put it in, right? Because these are lasting decisions. So what happens if these 2x levered ETFs don't sustain and they put this in the NASDAQ? So I just think that's like probably the next big event that on the radar that would be on the lookout for volatility around. And I personally just see very little chance, which is probably non-consensus, I guess, given markets views here, that it gets included in the NASDAQ.
I think I don't really have a view if it's getting its inclusion or not. I think there's like, as that premium, anytime that premium blows out, I mean, that's the tough thing is, right? Because if there's a huge premium on it, then it's hard to buy puts. But like if you have that premium blowout and you have it into this catalyst, then there's an interesting situation. I'll just say, there's, on the whole, like Michael Saylor thing, I think it's like, I just think about it from a trader's perspective, because I'm not like a true believer or anything. But I still just like have questions about like his plan, because I know he like throws this narrative out there and floats this of like, well, like the Bitcoin thing and this and that, and like we're gonna hold it forever and whatever else it might be, and they're just continuing to lever up. But I just think there's like something else kind of like going on behind the scenes about like why he's doing that exactly, and like the ultimate kind of like maybe moment we're moving toward in terms of like his exposure or whatever that might be, when like because once you get to a certain level of money, you can say you're not going to sell, but like there's always a moment.
I can't talk about this specifically, but so I got to give you a little history. I used to trade at one of the largest income funds in the country.
Okay.
So what we did was essentially you owned like all the big ass, mega cap stocks. And what we would do is like when there is volatility in specific, say big stock, you sell 50,000 calls and you take in that little extra yield for the income fund.
Right.
And so every boomer in the country owns this thing. And essentially, over 25, 30 years, you lower the volatility of all these stocks and you end up growing like GDP, right? Because you're just constantly just like picking up nickels in front of a steamroller, selling calls, right? So I'm just talking big existential high level here.
Yep.
If you're starting a new monetary system, it's going to be high volatility. And one of the interesting things, and I can't say, we don't own this name, but a Bitcoin miner reported earnings last week. And they said, we're starting an asset management arm for our hodling. And we are going to be figuring out ways to enhance yield of the Bitcoin on our balance sheet. Essentially selling puts, buying calls, right? Enhancing, you take that yield in, but you're smushing volatility in that asset class. As these Bitcoin miners it's a self-fulfilling prophecy. You can issue converts. Now you can hodl more, right? You don't have
Well, they're not smashing the volatility. They're taking the volatility.
They're selling vol against their Bitcoin.
But they're taking exposure for that vol. They're not just it's still getting expressed somewhere, right?
Yeah, you're selling call overwriting positions. Like if you have a balance, right? You can say, I'm going to sell 10% out of the money calls on my Bitcoin, right?
Totally. Yeah, but that compression of vol or them doing that is not necessarily like they're still taking on risk to do that.
Yeah. I mean, like it could get called away, but you get the cash, right?
Sure.
And, there's a certain amount of risk, but over 95% of options expire worthless.
Right.
So over time, you're enhancing the portfolio's yield on this asset class. Anyway, what I'm getting at is that his main thing, what if it's a $10 trillion asset and he or they, anybody in the sector can use the hodl and then essentially sell volatility against it and create yield. You don't ever have to sell. That's hundreds of billions of dollars of yield. It's like a new banking system. You know what I mean? So you might never have to sell because there's the fiat system has to keep the liquidity cycle has to keep printing anyway. Does that make?
Yeah, no, I get that. I think that's a fair point. I just think the more, so like in my view, the more you have like these massive players just take parts of the float, the less utility it's going to provide in terms of this whole like idea of a new monetary system. So like I think like it's still fair. Like I think if we go to 10 trillion, then sure, then you can just sell your calls and do all that stuff. Yeah, like that makes sense. Like no problem with that. I just think like at what point like is all the Bitcoin like going to, like is it going to go private, right? Because if you just have all these massive companies come in and start taking sections of the float, then you're not really providing any marginal utility to like other people, right? So like I just think about it like that.
That's a great point. But if you have nation states buying and it goes to $1 million, it's just revaluing relative to.
But I think this is why I'm also in the camp of not thinking it's a currency. It's a collateral asset.
Yes.
Because
reserve asset. Yeah.
A reserve asset for not just individuals. I fade the El Salvador idea of being able to pay for your coffee with Bitcoin.
The whole problem with that idea is that like you can have a holder who bought really early have as much Bitcoin as like a nation state, right? Like that's the issue, right? Like
I also agree with
problem.
capital flows. I agree with you here because I would say what you guys are implying is that trees can grow to the sky. Like we've seen time and again. I mean, if the Fed's just cutting with growth and inflation where it's at, and it can for a period of time. But I think it is on a long-term basis impossible for it as a now macro financial asset to get too extended from its macro corollaries, basically. Like, and for it to play out in that sense, I think it would have to get. But if you're right, Tyler, that would be considered a revaluation, like where just step function change higher. But I just don't think that's the case yet. I think there's maybe. Yeah.
If it's the first turning and you have a global renegotiation, like this is part of the Michael Millerman talk. It's like this is a global renegotiation of the social contract away from capital, away from globalism, away from the military industrial complex, and towards a multipolar world. Then maybe that revaluation for labor comes from something like Bitcoin, which says, you know what, this is the one thing that keeps up with the inflation. If my wage doesn't go up as much as Bitcoin, then I'm getting diluted from my fiat currency. That's existentially talking. I totally agree with you guys. Like your realities could very well be true, but so could mine.
No.
We gotta have you back more often. I love you busting my balls.
Yeah, I love it. Guys, I gotta jump. We might have to end it here. But Capital, it was a ton of fun to get you on the show. We got to do this again. We'll link your Substack in the show notes and get you some love there. But really appreciate all you do, and it was a ton of fun to have you on.
Hey, I appreciate you guys. This is a blast.
Good stuff.
Thanks.
Have a good
Hell
weekend,
yeah.
boys.
Love it.
All right, fellas.
See ya.
Peace.
Looking for a blockchain that combines high performance with zero headaches? Scale is your answer. With its advanced parallel processing and modular sharding, Scale delivers gas-free transactions and limitless scalability, perfect for gaming, AI, and consumer-facing dApps. Already a top 10 blockchain on dApp radar, Scale is powering next-gen use cases with over 750 million transactions and counting. Discover the future of Web3 at scale.space/ecosystem and stay up to date with their journey on X at Scale Network.